Hello again, everybody. Well, I've decided that to try to get the Simon Says podcast to go viral, I need to bring in some guests to help me out here. So I know things are a little crazy these days, so I figured I'd bring on some experts to talk about why the world is the way that it is, not just today, but for the last decade or two, and people who were behind all this and are still behind on it. So I've invited this guy, I think you recognize him, and this guy on the Simon Says podcast, who hopefully will be here live to talk about the state of the world, but they have not returned my emails or inquiries. So the current president and former president are not going to be on the Simon Says podcast, but don't despair. I think that would be a little too heavy anyway, and I'd probably end up making a lot of you mad. So let's just lighten up here and let's go to the entertainment world. That's right. I invited on the Simon Says podcast this guy, I think you recognize him, and you have to know who else is going to be invited. This young lady right here, I think you know her, but their representatives have not gotten back to me. So that's 2 strikes. So I've decided to stay in my lane. I have sent out invites to 2 of the best known and successful investment and financial experts. I know you all know who I'm talking about. This guy right here, of course, and this gentleman right here are going to be live right now on the Simon Says podcast. So without further ado, my esteemed colleagues and members of the One Private Wealth team who did answer with an affirmative that they are going to be a part of this podcast. So here we go. My longtime business partner, Tom Cordes, like 58 years or something we've been together, 26?
Might be 26.
26
Might be 26
years.
now.
Yes.
Yeah, 26.
So Tom is a chartered financial analyst and hired you in the late 90s. We're going to get to that in a second. And this gentleman down here who's taking a sip from his One Private Wealth cup is Brandon Mallinckrodt. Brandon is a certified financial planner like myself and 17-year veteran of the business, right? So we've been meeting a lot lately, actually, and having team meetings because of everything that's been going on in the economy and in the financial markets this quarter. One of the things that people see in my commentary all the time is, are we in this rotation? And we've heard this term a lot, and it looks like, okay, it's all high growth tech stocks. That's what has led the market for a couple of years. And now all of a sudden, those have been dropping, and these boring dividend-paying value stocks have taken the lead. In your opinion, as you guys do research, do you think, is this just a short little turn, because we've been teased before, or do you think that this has some sustainability, that maybe we're going to see a gap close between growth and value? Tom, what do you think?
It certainly feels like it. Growth stocks have led for the last 2 years. Really, I had a really rough 2022, but a great 23 and 24. But just like when I started in the late 90s, right? These stocks kind of overextended themselves and got really expensive, had a lot of earnings growth assumptions baked into them. So there's stocks that are cheaper, and those stocks haven't performed nearly as well, but I think there might be something to it. And we love it because I'm probably defensive more than anything, and that might have a little bit to do with when we started the business. But yeah, I think there's probably some truth to that.
So Brandon, what do you have, anything in particular to add to that, or maybe talk about some other asset classes that might be turning? How do you see the world right now from a financial standpoint?
Yeah, so I think Tom is correct to say that we have definitely seen maybe an extension in those long duration assets, some of those high flying growth names. And I think if we could get a rotation out of those names to maybe some of the consumer staples, consumer discretionary names that we think are opportunities that maybe haven't been as extended, will be a great place. And I think looking at some of the portfolios we manage for clients, I think that will be a good opportunity for us to kind of massage things around the edges to take advantage of the opportunities we see in the current environment.
You know, you both of you entered into this industry at very unique times, and I want to ask you about that. So I hired Tom right at the peak of the internet bubble, and you got a little whiff of that bubble. And then, of course, the internet
party
bubble
was almost over.
Yeah,
it was like
right
10
near the
p.m.
top. Yeah, that's
so
right.
we had a couple hours, but
yeah. And then Brandon, a little bit later, you get into the business right near the peak of the great financial crisis.
Yes.
But I think that the good part about that for both of you is you learned some of the pain of this industry early. Tom, how has this colored you in terms of what you went through in those early days? Your first few years is you saw nothing but the market go down. How do you think that made you a better investment advisor?
I think there's a stat that says, if you just hold on long enough, you make money, right? Like, just time. Well, I think for every 10-year period, it's something like 95% of 10-year periods are positive.
Yeah.
Well, from the 10-year point from when I started in sort of, let's call it late 99, early 2000s, the market didn't do anything for 10 years. And you think 10 years later, like, what are we doing? How are we helping people, right? How are we helping people? But valuations were too high, which we talked a little bit about before with the high growth stocks today. But I have looked outside of just those high growth areas, I think. And that's sort of maybe the pedigree that I have, which is more value-based, more dividend-based. The portfolio that a lot of our clients are in is called dividend-focused. We always say, even if the market stays flat for a year, you're going to make the yield. And whatever that yield is, it's fluctuated between, say, 3 and 5% the last 10, 15 years. So that gives me a lot of comfort. But I think that's probably how starting in that time frame really did color the way that I think about investments and portfolio management.
And you mentioned 2000s. Turned out, a lot of people don't realize this, but the 2000s in terms of market returns actually slightly worse than the 1930s, which is amazing. And you guys were getting into the business, you at the beginning of it, about halfway through there. And so for you, Brandon, you get in right when the housing market's doing great, everyone's making a lot of money, mortgage industry is booming, and then everything crashes, even worse than the internet bubble. So how, in your beginning years, how did that color you as an investment advisor and perhaps make you a more successful one? Because that was the beginning for you.
That was the very beginning. So to get right into the business when everything starts to just collapse was a thing where I almost took it on my shoulders and thought, I am just the bad karma for the industry and for everybody out there. And I need to leave this process in this place as quickly as possible because the market just was collapsing. There were days where people were losing 5, 6, 7, 8%, and everybody did not know what to do. They couldn't understand how we were going to get out of this situation. We started to get the backstop from the government, which made everything start to turn around. We saw a little reprieve, but things lasted until March of 2009, which almost took me for my first year of being in the business to see the market go down 50%. And for me personally, I think it gave me the mindset of protecting assets as the number one priority. We can always find growth, we can add a little bit more exposure for clients, but the protection of assets was the thing that was at the forefront of my mind after going through that experience.
And you saw it from a different angle because in the early part of your career, you called on advisors. So you got to see how they reacted at the time. What did you learn from that? And the reason, and I'll set this up a little bit, is that when I was a reporter back in the day when I had hair, you guys know the story, the 87 crash, I was a reporter in Wichita, Kansas. And so I was told to go cover the story. So I went into a well-known brokerage office and saw how advisors were managing that particular day, October 19th of 87. And they were doing one of two things, either agreeing with their panicked clients, okay, we'll get out. Okay, this is terrible. Or they would be yelling to their receptionist and saying, I can't take any more calls. Yes. I don't know that either approach was correct. What was your vantage point when you were talking to other advisors at that time?
Yeah, so thinking back on those times, it was dramatic to go into lots of different offices because everybody was running different types of businesses. You had people that were individual stock traders for their clients. You had people who were doing financial planning. You had bond traders. So it was a plethora of opportunities to see how people would handle their clients and what was the best approach to handle them through these tough times. And so for me, things that stand out are what you said, people not taking phone calls, but then you also had people who were willing to just do whatever the client wanted because they did not want to lose the client. And I think sometimes that was at the detriment of the client and also the advisor. And there's a story that comes to mind when I think about that. There was a person who I could always count on. This happened 4 times where when they wanted to buy, you knew it was the top. And when they were wanting to sell, you knew it was the time to buy because that was the bottom. And that happened exactly in March. It was March 9th when that call came in. And I knew this is the time where we should be putting money to work.
Yeah. Well, let's talk about that same concept then as advisors, because we've all been through the highs and the lows of the lows, and we deal with clients at that time. Tom, do you think it's harder to manage money and to talk to clients at market tops and everyone's like, I'm ready to buy more and more and more and more, or is it harder at market bottoms to get them to say we need to stick with the plan?
Boy, that's a really good question. It is tricky, right? I mean, it is tricky. I was thinking about that when, we need to talk reasonableness to clients, but when they get emotional, when they use emotions of fear and greed, it often sort of clouds their judgment a lot. It's probably easier to try to talk someone at the top to diversify maybe just a little bit more. I think that's a little easier. Toward the bottom, there's been so much pain, and based on all these studies that we've seen over the last 10, 15 years, people experience pain twice as much as they feel pleasure. It's kind of an interesting way to think about it, but fear, the intensity is higher, I guess is the best way to describe that. And people just, they're deer in the headlights at that point, so it's a little harder. Talking to them at the top, it's a little easier to say, well, maybe we should look at this area over here that hasn't done so well. That's probably the best way I can answer that.
Yeah, and I think people who you have to have experienced it for as an investor. I think if you've never experienced a really bad bear market where things can go down 40 or 50%, that might be more difficult to talk to that person. But clients that we've had through all that, they've been through it, and they're like, I totally get it.
But the first time is always different, right? The first time is always different for a client because they just start extrapolating what happened yesterday, last week, last month, and say, oh, if this just keeps going, I'm broken, fill in the blank, right? And then, because people change, right? People change. You think that if your portfolio went down 10%, how would you react? Well, if they know it's going to go up 15 the next year, they say, oh, no problem. But they don't know that. And the more it goes down, the more fear starts to build. And that's what becomes challenging, but that's probably what gives us job security too.
Yeah, no question. And by the way, you might have been able to tell there's a little bit of an age difference between the three, and that's very intentional. There's like a 15-year age difference here. And what is it for you guys? 8 years. 8 years or so? Okay. I bring that up because, Brandon, I want to talk to you about the under 40 crowd, although you're about to turn 40, but the younger generation, I think you guys are more in tune to cryptocurrency and Bitcoin and some of the other stuff that's come out. It's not something that I think most investors should really pay too much attention to, but you probably talk to people in your circle, your influence out in the world of younger generation. So how do you approach that if somebody says, well, are you guys doing Bitcoin? Or are you doing these, NFTs? And are you doing all this, these SPACs and all this new stuff? To try to get a younger generation to invest in a more boring way to really build wealth, how do you approach that?
So kind of goes back to what you were mentioning earlier about what is the pain threshold for people too. And when we have had a consistent bull market in every asset class for at least the last 15 years, I look at it and say, okay, we need to have a little pain for the people who have never experienced it before, for them to understand what it's like for an asset class to drop 20, 30, 40%. And these people who are getting into the market now, who are investing in crypto, have only seen crypto go to the moon over the last 8 years. So for them, the only piece of advice that I could give them is things don't always go up in this linear fashion where they are always going up, always going to earn you 20% returns. No matter what Michael Saylor tells you about Bitcoin, it's not going to give you 40% every single year. There will be some corrections, which we have experienced over the last couple months.
It's just experience, I mean, like when you've been through the cycles before, you're like, oh, I remember fill in the blank, whether it's NVIDIA compared to Cisco, you're like, oh, they're dominating everything. I'm like, well, Cisco was dominating everything too in 99 and 2000. And the earnings, the revenues, all the metrics in the stock continue to go up from 2000 to 2010. and the stock did nothing but go down during that time frame. So it's all about valuations and sort of like, why do you put a price target on Bitcoin? Well, I don't know. Okay, you can justify that somehow, right? But for us, I think a lot of times we think in terms of, give us your serious money. Right? We've said this to clients before, like, you know, we have 90% of the money and then they take 10%. They do whatever they want with it. So if they make mistakes, and that's like, you know, that's kind of on them, but they're not going to go broke, right? They're not going to go broke.
Right. I'm thinking of the 2000s, basically. I'm sorry, the 2010s. We just came off the best 15-year period in the history of the stock market. When I saw that in the last week or two, I actually didn't realize that. I knew it had been a great 15-year period at the end of the Great Recession. The best 15-year period in the history of the stock market. Let's talk regression to the mean, all right? That's a technical term that basically says, look, if your average is here and you've spent a lot of time up here, maybe it's time to spend time down here. Can that be repealed? I mean, let's move beyond 2025 and for the next decade plus. Isn't it reasonable for investors to start thinking about lower than average returns?
I think a lot of companies have, Vanguard, of course, very well known, probably one of the largest wealth managers in the world, recently came out with, you know, their 10-year forecast, and it's substantially lower than, you know, let's just call stocks at 10%, maybe small caps at 11, and bonds at maybe, I don't know, 5 or 6 or whatever is historically normal for them. But I think for U.S. stocks, they're down in like the mid-single digit range. Not like it's, you know, 7 or 8 or 9. It's in the 4, 5, and 6% range now. Some they feel will do better. They feel, I think, the value will do better than growth because growth has done really well. But give it these big chunks between 2000 and 2010. Horrible. You made no money. Yeah. And then from 10 to 15, from 10 to 25, I'll call it, right? The last 15 years, like you mentioned. What are stocks done? 15% a year, something like that for the last 15 years? Yeah, stocks aren't going to do, you know, you can almost firmly say that stocks aren't going to do 15% for the next 15 years from here. Like that would be, you know, AI would have to revolutionize the world and everything and repeal a lot of the rules that I think we've been accustomed to. But yeah, you know, cycles move like that. I mean, they move in bigger chunks, like decades. So am I worried about the next 15 years? Yeah, but I'm worried about everything. I'm always worried about everything, right?
Well, you still have all your hair, though. You haven't pulled it out yet.
Yeah, that's our job.
So, Brandon, on that, so if that's true, and I have no reason to doubt it because that's how we're sort of managing money with that in mind, that maybe equities don't give us the kinds of returns that we had in the last 15 years. Well, there are lots of other asset classes. So do we look at international? Do we look at different kinds of fixed income? Kind of explain how maybe One Private Wealth is looking at this and what you see for the next decade plus.
Yeah, so I think I am in the same exact camp with both of you guys. I think we've had extended returns in the equities, especially large cap growth. So if we see a rotation out of large cap growth, maybe into small caps, also into international as well. But if we get a massive regression back to what that average is over time for stocks, we should see something in that 2 to 5% range return. And so if we're in that 2 to 5% range, where can we find other opportunities? As you mentioned, international could be a good pickup for us because we have seen massive outperformance by US equities versus international equities. So that could be a place for clients to get exposure and also get returns. Also, the dividend payers. If you are needing to get 4, 5, 6% returns on a yearly basis to make sure your plan stays intact, well, if we can get 4 to 6 on bonds, we can get 4% on dividend paying stocks, you're going to be pretty happy if stocks go sideways and you earn that yield and you meet all your needs. Because for our clients, if they're able to consistently live their life, reduce the volatility, not have to worry about their portfolios, that's number one thing in my book.
Yeah.
You know, but everything is cheap relative to the U.S. growth stocks.
Well, that's true.
Everything. That's true. We've seen, I think, year to date, the German market's up more than 10%.
Most European stock markets.
And the U.S. market's down 5%.
Yes.
So it's like there's already a 15% gap, and we're, 10 weeks? So that's 9, 10 weeks into the year. So it happens very quickly. So there's a lot of asset classes out there that have just been laid to rest for the last decade. Because they don't, and admittedly so, they don't have the earnings growth that the large cap U.S. stocks have had. So, you know, that's been where the earnings growth is, so that's been where the stock performance has been.
Yeah. Well, let's kind of talk politics without talking politics. We can't ignore it right now. It's something that the three of us talk about all the time and how all of this is, if tariffs are on, tariffs are off. Doge is cutting here, but these people are being hired back. All of a sudden, foreign international markets are doing much better than us, as you had mentioned. So how do you see managing money, whether it's us or do-it-yourself investors? We tell them all the time, don't let politics influence how you invest, but it's almost difficult to ignore. So I guess the way that I would answer this in a broader sense is, in the face of volatility, what would be your advice to investors? You stay put if your plan is reasonable. Make sure that you've got other places in mind. I mean, give us some advice on that.
Gosh, I mean, the easy answer is always stay diversified, right? I mean, that's always like, oh, stay diversified. That makes sense. I would just do it in slow, small increments over time. Normally, that's the way that I move the models. That's the way that I manage my own personal portfolio. I never jump in with both feet. It's always like you dip a toe in, then you keep sort of adding over time. You try to reduce. It's all about reducing the big mistake, right? I mean, our goal is risk managers. That's what we do. I mean, anybody can buy the S&P 500 and pay almost no expense on it. And you got to live through the, up 28% one year and down 22 the next year, and you got to live through these 07 to 09, 57% corrections in the market. It's like that's painful, right? But if you have other asset classes, you got a little bit of commodities over here. Gold is an asset class that some of our models have recently added over the last few quarters. International, we continue to add to those spaces. So, it's like you stay diversified. You're always going to have some assets that are not performing well. And if you look at your portfolio and everything is up, you're probably not diversified enough. I mean, it sounds silly, but it's like you can always pick something and say, this is down and this is down and this is down. You said, yeah, but that's 3 out of 10. If 7 out of 10 are up, then you're probably where you should be.
You had mentioned something before, Tom, that the pain that people feel on a loss is exponentially more than what they feel when they're making money. So to your point, what we've noticed, I know, is when we look at someone's portfolio, you could have 9 winners and 1 that's down. The average investor is going to focus on what?
Yeah, the one that's down.
The one that's down. And you have to be very careful about that, because that one actually is giving you some diversification that may help a little bit later. So Brandon, same question for you as you talk to investors. Through this world today where everything eventually seems to come back to politics in some way, but we try to tell investors, don't use politics as a guide to build your portfolio. It's really difficult, though, to do that. So what would be your advice in terms of telling investors how to stay diversified, how to invest in today's market?
So I think looking at the current environment, we run into headline risk on a daily basis. And we don't know what is actually going to come to fruition, what is going to be put in place. And I think we run into major risk when it comes to managing portfolios if we start to make decisions based upon something that is seen on TV or something we hear on Twitter or anything like that from your neighbors as well. So for us, it's taking in all the information that we can accumulate and then making good decisions from there on what we should do with the portfolio. As Tom mentioned earlier, making those small decisions to turn the ship just a little bit here and there can make drastic changes in the overall performance of things. And sometimes it's better to kind of massage around the edges than it is to try to make drastic changes at one point in time, because if you make the drastic change, you're going to have a drastic result. And so that is going to be to the detriment of most investors because they let their emotions get involved.
Yeah.
And you got to know that you're never going to get the timing exactly right.
Never.
We always talk about this ladder thing, right? Like the ladder of investing, you don't get on the first rung and off on the top rung and just say, let's do that again. You get on the third and get off on the 7th and say, that was a good trade, like that worked out. Or, don't get on the 10th and ride it all the way down to the bottom, right? That's where the real trouble happens. But give yourself some grace too, right? Give yourself some grace. Every time I sell a stock, it goes up. Every time I buy a stock, it goes down. This gets back to that emotion, right? Gets back to that emotion of the pain of the down is more intense than the pleasure of the up, because well, stocks should go up, right? So if you buy a stock and it goes up 10%, you say, well, darn it, that's what the market should do. That's what they all should do, right? But it doesn't always work out like that.
Yeah. So, Brandon, I'm going to start with you on this, and I'm talking about investor mistakes. Okay, what do you think in your 17 years that might be one of the biggest mistakes that you would try to remind our audience of? Let's try to. And I'm kind of putting you guys on the spot on that because we haven't talked about it, but let's talk about some of the possibilities. Market timing, giving into emotion, following the crowd, spending too much money. We got to talk about that stuff. So with all of those things out there, what do you think might be maybe the number one mistake that you see repeated over and over again?
So I think I'll give you 2 examples. So I think if you asked earlier about the younger crowd. The younger crowd, I think, is falling into this FOMO trap. So the fear of missing out. A lot of times they see what is posted online, they see everybody else living this great life, posting all of their highlight reels for everyone else to see, and they think they're behind. So they go and they try to stretch with the risk that they take and the risk that they put in their portfolio. And that became apparent with the NFTs, it became apparent with Bitcoin. Everybody thought it was going to continue to go up forever. And so I think we look at it and say, okay, you need to understand that these asset classes should be owned in small percentages for your overall allocation, not all of the money that you have. Do you have anything on that?
No,
one?
I mean, there's been a lot. I mean, gosh, concentration risk, non-diversification, and people say, well, Warren Buffett's, he's concentrated, and Bill Gates is concentrated, and I want to remind people, you're not Warren Buffett, right? You're not Bill Gates, probably, and those guys have a lot of outside money too. That's not just in their companies. Letting fear and greed judge your investment decisions. That's as much as anything, right? I mean, it's sort of at the top, everybody says, well, geez, gosh, my neighbor made more than I did, or the taxi guy was telling me about this stock that I should have bought. And you say, yeah, but we always get back to like the plan, the process, and then the product, right? The product is sort of the end result that people want to focus on. What do we own and what don't we own? But like the plan, the financial plan starts it, and then the process says what asset classes should we own and at what percentages should we own them. And we don't start with, well, we should own Microsoft or whatever company this is because that fits into the plan. You're like, no, the plan comes first, then the product comes after that.
Yeah, that's a great point. Let me step off that, because I think people tend to think of individual stocks or ETFs to say, that's the one that I have to own. Instead of, I think, looking at their bigger picture to say, no, you just have to be in the right area. For example, we've said this before, you could have the worst performing small cap value fund in a particular year where small cap value does great, and it will beat the hottest large cap growth from the year before because that area is down. Diversification takes care of that in a lot of ways. So you can't always be chasing the hottest because you will miss it. You stay diversified, and that means by guaranteed, you will be in a place that's always doing the best.
Right. Yeah. Yep. Those are all good points, and you may actually be more successful buying everything that was down last year.
That's hard to do.
I mean, I looked at a big color chart at the end of 24, 2 months ago. And I just looked at all the green and all the big stocks, and they did so well last year. And I was like, what was down? What was down last year?
Yes.
The best performers that we have? The 3 stocks that were down a lot in our big model. And I can name them, but they're all healthcare stocks. They're like, why do we own that? Why do we own that? Why do we own that? Like, I know they're good, high quality companies that pay good dividends. They got, great balance sheets. And sure enough, this year, they're all up double digits. Yep. I was like, thank goodness we didn't sell stocks in December.
There's a lesson.
They're hanging in there this year, right?
Well, you guys have been great. I'm going to wrap this up with a egregiously self-promoting question for our team. Yes.
No.
Yes. So I will answer this first. So it gives you guys a minute to think about. And that is, I think what makes us a successful team. And think about that. And I'm being serious about this, in that we could show you the awards and we can show you all that. That's fine. But there's a reason why we have been successful for a number of years. And so for me, I think one of them, I'll give you 2 reasons. One, our talents complement each other very well. Tom here is more of the analytical thinker and is a little bit more even keel. I'm, the CFA, if you will, where I love to look at 30,000 foot view parts of the markets and the economy, and Tom certainly does that, but then we'll dig a little bit deeper. And Brandon, I always kind of look at you as like the Jose Oquendo of the Cardinals. For those, maybe some of you don't remember that he was like this guy that could do a little bit of everything. He played all 9 positions. And so Brandon, you do that well, that you can fit in and you can sit with Tom and do some of the analytical part of our business, but you will also come into my office and meet with clients as well and do some of the financial planning. And I think that is we complement each other very, very well. And then the second one, I think, is of the service model. I don't know of a team that does any better in just making sure that calls are returned that day, emails are returned the same day, making sure our clients are always informed of what's going on. So that sets the stage. Brandon, I'll start with you. What do you think we do well?
Well, I would say that we are the best team, not just in the state, but also in the country. Might even stretch that a little further from there. But I think a couple of the points that I like that you said too, the white glove service. For us, it is most important that we take care of clients first and foremost. And I think all of our personalities together make sure that we continue to keep our clients wealthy. And that is the number one priority for me. Is I want to make sure that clients are always secure. Clients call in and talk to us, and they want to know, how am I doing? Am I going to be okay? No matter what the market's doing. If the market's doing great, maybe we have a little bit less of those phone calls, but when the market's going down, I want clients to know that we're always here for them, and that no matter what they have going on in their life, we're going to be there. Whether it's something emotional going on, a death, whether it's something financial, a big decision that they're looking to make, I want them to know they come to us, and that's what other people can expect from us as well, is you come to us with all of the decisions that you want to make in your life, and we will be there to support you through it.
Yep. Mr. Cordes.
I'm always amazed when I call other professionals in our industry, more like lawyers, CPAs and whatnot, and you don't get a call back for like 2 weeks. Yeah, I don't know how people do business like that. I mean, we used to sort of say you get a call back that same day, and now with emails and stuff, sometimes we get emails at 6 o'clock at night. Well, a lot of times I respond to those, but a lot of times you don't too. Right. But always know that you're dependable, right? I mean, people love McDonald's because it's consistent. It's the same in New York, it's the same in Texas, it's probably the same like in Chicago and China and everywhere else, right? It's a very consistent experience that they have, whether you like that or not, it's consistent. I think our clients have gotten to know us, that our service is as good as anything. And we're honest with clients, right? I mean, we've told clients many times over the last 25 years, you know what, I think you're spending too much money. I think you're taking too much risk. There's been wealthy people that we haven't taken as clients because we've made the decision, that's too much risk for us. Because we say, this thing only ends in 2 ways. Either they die early with money or they live too long and they're broke. And I'm like, we set expectations to say, we're not going to give you the best performance of any financial advisory team, right? But we're going to give you good performance with prudent management and what I think is the best service model in the country.
When you see the surveys, where does performance rank in terms of a client's biggest goals? It's always down.
It's like number 7 out of 10
yes.
on most surveys.
Yeah. It's trust. It's, can I count on these guys to take care of me and my family? And can they at least put me in the game where I'm reaching my goals?
Communication, financial planning, proactive management, calls, proactive phone calls, things like that are always. Communication's always at the top. Yeah. It's always at the top.
We don't beat ourselves, thump our chest very often or pat ourselves on the back. But I allowed us for that one moment. We did that, but maybe next time. So, Tom Cordes, Brandon Mallinckrodt, thank you so much. It's been a fun ride, and let's keep this going for a few more years, all right, at least. All right, everyone, thanks for joining us. I think these guys were great, and I started to think they may not want to do this, but I'm going to have them back on, I think, a little bit more often. So I hope that's helpful, folks. And go to the website, of course, 1pwm.com. It's very easy to remember, so if you want to send any of us an email and ask any questions, you'll see our contact information there. Thanks for joining us. Until next time, take care.